What makes stocks go down? We know that stocks fluctuate both up and down in price while you own them, but what is it that really makes them go down? Is it bear markets? Is it individual market news? How can you manage your risk around stocks that you own? That's what I'll be talking about in this video, is understanding what makes them go down, because when we understand why things happen, we can do something about it. Hi, I'm Camille here, and on my website, retirecertain.com, I share information for proactive investors. I share information about strategies that optimize investment savings, strategies other than long-term buy and hold investing for decades in stocks and bonds, because, well, in some decades that works, and in some decades we know that that doesn't work from the historical data that we can see. And I also share information about income streams, because the more income sources we have in retirement, the less savings we need for retirement withdrawals. In this video, I want to talk about what makes stocks go down, because pretty much all stock market investors have experienced this. The first thing or reason that stocks go down is because the company earns less money, or it announces that they think they're going to earn less money. It doesn't even have to necessarily happen. They can just say they think it's going to happen. We know that we buy stocks because we want to invest in the earnings of a company. That's the old-fashioned reason that investors buy into the stock market, or buy stocks, I should say. And now there is more of a focus in just buying into the stock market, or buying into the market because they feel like it's going to go up, or it's the thing that they should do. But the real reason that we invest in stocks, the old-fashioned reason, is because the company is going to make money. And when a company doesn't make money, or they say they're going to make less money than they've been making, well, that makes the company's stock drop, because, well, fewer people want to earn a company that is not making the earnings that they thought they were going to make when they bought into the company. The next reason that a company's stock drops is because they cut their dividends. This is not terribly uncommon. Usually companies that are growing are able to increase their dividends over time, but sometimes things change. Companies aren't making as much money, so they're not able to pay out as much money in dividends. Sometimes companies just change their strategy, so they decide that they want to take that money they're making and funnel it back into growing the company and maybe increasing profitability, and so they cut the dividends that they're paying out to shareholders. Now, some shareholders may say, fine, I'd rather the company funnel the money back in and grow the company. But if an investor has bought the stock because they want dividends, or they need dividend income, then they're not going to be that interested in the stock. And in general and overall, usually when a company cuts their dividends, it's negative and the stock price declines. The third reason that companies cut or drop in price, I should say, is because the company's product becomes obsolete. We've seen this happen so much over the past few decades as technology has changed. Products that once we couldn't live without, to things that we just completely don't use or need anymore. So when a company's product becomes obsolete or even dated, or it's anticipated that the product will become obsolete, then the stock price of the company declines. Now, in this situation, oftentimes companies can buy another company that is more technology savvy, more current, and integrate that into their company and remain profitable and go on to be a market leader. Often, however, that doesn't happen. It's too hard to implement, and the stock price continues to decline. This scares investors, and investors tend to flee the company's stock. The next reason that stock prices go down is because competition increases. A company can be the dominant player in the market, or even dominant 2 or 3 players in the market, and someone new comes on, or someone overtakes the lead company in a market. And when this happens, it can significantly hurt earnings. It just sends a negative association with the company in general, and the company's stock suffers as a result. The next reason that stock prices go down is because of unusual company news. Often this is about CEO or other top executives of a company. It can be anything from relationships to fraud to who knows, various other things that drive the company's stock price down. The next reason that a stock drops in price is because the market as a whole drops. And I think this one is so important for investors to remember. It has nothing to do with the fact that the company is a great company, the company is making money, the company is growing, but investors as a whole flee the stock market. And when this happens, overall market declines, bear markets, especially extended bear markets, tend to take all stocks down with them. Even though there are the few anomalies, most stocks decline with an overall market decline. So that's a big one. So I think it's important for investors to remember this one most of all. All right, the next reason that stocks go down in price is because large institutions sell the stock. You can just imagine when companies, large institutions that manage billions of dollars buy into a stock in their various funds or for their various clients, it drives up the price of the stock. And when a company decides they no longer want to own that stock, maybe they're rotating out of growth and into value, or maybe they are preparing for uncertain financial times or financial crisis that they foresee on the horizon, and they're increasing cash in their portfolios. Whatever the reason, when large institutions sell the stock, it has a huge impact on the price of the stock as opposed to just the individual investors. The next reason that stocks decline in value, or in price rather, is because the stock sector becomes out of favor. An example of this may be that oil stocks, for example, go out of favor, or pharmaceutical companies go out of favor due to some sort of regulation. I recall that happening a couple of decades ago. There are various reasons that sectors go out of favor, and when they do, investors sell and institutions sell the stocks and or funds that own the stocks in those sectors, and that naturally drives down the price of that particular company. It may not be that because the company is not making as much money, although a lot of the times it is a sort of underlying theme is that the company is entering into a time period where it will be hard for them to maintain their profitability that they've previously had. The next reason that a stock goes out of favor is because there's a rotation out of the type of stock it is. For example, stocks experience long-term rotations and cycles in and out of growth type stocks and value type stocks. Huge amounts of funds will rotate in and out of these sectors. Technology is a growth type of stock, for example. And when investors decide they want more value-oriented stocks, then that will lower the price of technology stocks simply because investors have decided they want to gravitate toward value-oriented types of stocks. This has less to do with a company's particular earnings, much like the sector I just discussed, the sector rotation, but it can often be a sign of things to come. Investors move from value to growth and vice versa based on the overall economic cycles, and the overall economic cycles are really driving factors behind the profitability of companies, and the profitability of companies is the driving factor behind stock prices, or at least logically and sensibly it should be, or the old-fashioned way that it is. Sometimes markets lose touch of this, which I've talked about in my investor emotion video, so make sure you take a look at that. And then the next reason that a stock decreases in price is because the economic cycle changes. Similar to what I was just touching on, the economic cycle changes from one of growth to one of a slowing economy, to one of an economy that could be in trouble. And when this happens, companies that were making money stop making money. It's harder to make money. And this means that investors sell the company because they are no longer making money, or investors anticipate that they will no longer be making money. And keep in mind that all of this is not necessarily just sort of you as the individual stock picker and what you've selected, as much as you can see from most of these events here that affect the price of stocks. It's more the market as a whole. It's more what institutions are doing. It's more what economic cycles are doing. And a lot of this is about things that are really, really outside of our control as investors. So you can be a really, really good stock picker, stock analyst, I should say, stock selector. But these other factors can be working against you, and it can cause stocks to decrease in price, even though you've chosen well. Keep in mind the same thing can happen on the upside, and make sure you watch my video for the reasons that stock prices go up. As you do all of this, remember to invest wisely so that you can retire certain.